Real estate is a partnership game. Don't do it all yourself. Get in partnership. The savings are largely in retirement accounts because that's how we've been trained to put away our savings. Our first single family property was like a couple miles. Why spend half an hour washing your own car when you can just pull through and get it done 5 minutes?
What is one actionable piece of advice you would give 25-year-old Whitney that the way that you build your portfolio?
I'll give 2 quick ones.
What's going on, everybody? Got an exciting episode today. We've got Whitney Elkins-Hutten. I hope I'm saying that correctly. And she is the Director of Investor Education at PassiveInvesting.com. We're going to talk about how you guys can get into bigger multifamily, self-storage, other commercial, how to tap into your residential properties and really get that cash flow going and up and start syndicating, start getting into bigger time residential stuff. So I'm excited. Whitney, thank you for taking the time to jump on the podcast today. I know we had to reschedule a couple of times for your shoulder surgery, and I hope you're recovering well from that as well.
Oh, well, thank you so much for having me on. And yeah, I couldn't be happier with the progress of my shoulder surgery. It's just, can we speed it up from 6 months to 2
Yeah,
months?
I know.
That's my only ask.
When I went to the doctor the first time and they confirmed I 100% tore my chest, they were like, it's going to be at least a year for you to be normal. And I'm like, no, this is the worst. It was really soul crushing. I'm going to be honest. But
Yeah.
Unfortunately, it just takes time to get over these things. That's how it goes.
Yeah, it was, I had my first post-op follow-up and I was feeling better, right? Definitely over the initial hump of the pain. And the doctor was like, I just want you to fully understand, you need to treat your arm as if you have 5 broken bones in it, because you do. We had to drill into 5 different bones. And I'm like, oh, well, since you put it that way, okay.
I can't just rehab this on my own anymore.
Yeah, right.
Yeah.
Okay. I need help.
Can't just push some dirt on it. So tell us some more about yourself, how you got started in real estate. You mentioned before the podcast, you read 40 residential homes at one point. Tell us about Whitney and her story.
Well, I'll start with the end.
Okay.
I'm the Director of Investor Education at PassiveInvesting.com. We're a private equity group based out of the Carolinas, and we focus on multifamily, express car washes, and real estate debt as our 3 main bread and butter investments. Before the government shut down, we were imminently launching a Regulation A fund for sophisticated investors. So depending on when the government reopens and when this podcast lands, we might have something for sophisticated investors to cut their teeth into with us. But that private equity was not where I started, not why I went to school. I actually went to school for chemistry, biochemistry, eventually into public health. There was a left-hand turn somewhere in my journey. My real estate journey actually starts in 2002. I bought a property with a significant other, and about a month later, that relationship fell apart. And I had the house. I was the money partner. I put down the down payment, secured the financing, but I was not the one that knew how to rehab the property at all. It had green shag carpet on the floors, psychedelic daisies painted all over the walls, straight out of the 1960s. And anyways, I learned a lot on that first deal. Bought the Home Depot 1-2-3 book, went through to a lot of free Home Depot classes to learn how to tile and do drywall, some of which I was good at, others I was not. But I sold that property 11 months later. In that time, I stuffed it full of roommates who were willing to pay me rent, even though they lived in a construction zone. And then when I sold that property 11 months later, it wasn't until after I sold it that I realized I probably made my first investing mistake, because that's when it clicked for me. The concept in the book, Rich Dad, Poor Dad, which my realtor had given me. I actually did have a property that was cash flowing. So I had been living those 11 months rent free or mortgage free. My tenants had been paying for it. And not only that, I'd been putting cash in my pocket. I borrowed money from my grandparents for the down payment and had paid them back with the forced equity on the property through a home equity line of credit. And so I was all in on that property, no money down, and was cash flowing, everybody's dream of an infinite return. But I didn't know what I didn't know. And I sold the property and got $52K in tax-free money because of the 121 exclusion. And it was after I sold that property, all the different things started falling in place. And I went, ooh, I actually just generated an infinite return
Yep.
on my nights and weekends that I didn't have to go to school for to figure out how to do.
Mm-hmm.
And I can do this again over and over and over as many times as I want. So, I continued to do live-in flips and house hacks. Some went incredibly well, some of them not so well at all. It's not a matter of if you're going to have a challenge, it's just a matter of when.
For
so
sure.
We can talk about any of those. But then it took a few years for me to realize, now I'm married. We're looking to have a child. And I was like, hey, we're not able to generate cash flow. I can't step away from my work. I can't pay for the groceries when we don't have a property exiting. And that's when somebody said, well, why don't you keep one of your live-in flips? I'm like, oh, genius. And turn it into a rental.
Right.
So I'm a ready, fire, aim type of person in some regards. And so we quickly scaled to 40 single family rentals in about a little over 2 years.
Wow.
Couple in state and then majority of them out of state.
Okay.
And then I realized I created another problem for myself. I had another job while I was working full time, trying to be a good spouse, trying to raise a child, trying to figure out how to put on my own oxygen mask. And that's when I was like, hey, I've hit this ceiling of achievement. I want to go into multifamily, but do I want to do it actively or passively? I didn't know the answer to that, so I did both. Anyways, we'll speed up the record there. And eventually, several years later, I am in partnership in over 800 million in active real estate assets.
Wow.
And then I also have our passive real estate portfolio. And really, it's our passive real estate portfolio that has afforded us our financial independence and freedom.
Wow.
And that's what I love helping people figure out how to do.
Yeah, that's amazing. That's honestly amazing. You accidentally syndicated your first deal successfully. That's amazing.
I've never heard of it. I never thought of it that way. Thank you. Yeah, I did.
Yeah. You borrowed money from your grandparents. You didn't put any of your own money, it sounds like, into the deal, outside of like it sounds like you put some money, time, effort, sweat equity right into updating it, right? But you really didn't put any true money of your money out of pocket to buy the building, the house. And then you had leased out to your friends. They were just handing you money and you were cash flowing, putting money in your own pocket, upgrading the place, and you sold it at the successful exit of around 52 grand. And that was infinite return because you started it with none of your own money. That's amazing. That's awesome. So, but it didn't go perfectly, and you improved on it going on forward to buy 40 in 2 years. That's incredible. I don't want to just speed past that. That's incredible. What would for somebody that wants to go out and kind of somewhat replicate that, build them a residential portfolio or even just a portfolio of commercial buildings, what do you think you did right in that? Because you had to have some kind of system to be able to do that with that kind of speed. What did that look like for you?
Well, let's be clear. There was about a 10-year gap or actually almost 12-year gap between buying that first property and then when I started actually doing rentals. So in that time period, I'm doing a lot of, and I shouldn't say a lot, probably 5 or 6 live-in flip deals. So got really good at building up equity. And because of the 121 exclusion, which is kind of like the 1031 exchange for, primary real estate, the roof over your head, I'm able to keep a lot of that tax free. And so I had great velocity of money. I didn't have that tax erosion. I'm also, my husband and I get married, and after a year or two, we figure out how to live almost on one paycheck and sock away the other. So we got really great at building equity. We got incredibly great at stuffing away our own savings. Now, in this time period, the savings are largely in our, retirement accounts because that's how we've been trained to put away our savings. I don't know if I help people think outside of that box as rather the first thing to do, maybe the 5th thing to do. But anyways, so we had this capital built and scaled, but we just hadn't landed on the methodology. So when, it's kind of like, somebody touches me on the forehead and now I can say, oh yeah, I can make this into a rental. Most people struggle right at that point in time because they don't have the equity, they don't have the capital. But in that 10-year time period, even though I didn't have the plan, didn't have the investing blueprint, everything I was doing was getting me prepared for that. So somebody's listening to this and they're like, boring, Whitney, you're saying save money and save as much as you possibly can, lower your expenses, create that as much delta and margin as you can in your personal portfolio. Yes, do that. 1, so you can get into your first deal if you need to use your own capital. But 2, even if you do figure out how to syndicate with other people's money, you need to have your own capital reserves.
Yeah.
We got to have that safety and liquidity, because either you're going to need it for yourself or you're going to need it for your business. So that was like the kind of the key thing there. And then it got to building systems. So, our first single family property was like a couple miles down the road, like 10 miles down the road, like the next town, 2 towns over actually. And I purposely bought it 10 miles away, and which could be 25 minutes drive, not super far, but not one that I'm going to make every single day. Like if something breaks on the property. And I purposely made myself use contractors because I was like, I want to scale and I don't need to be the one swinging the hammer and doing everything. Now, my husband did do the painting on the deal, and that took him 1 week, every single night that week. And he was like, like I'm done painting. I'm not going to do any more repairs on this property. I get you. I see what you're trying to do here.
Yeah.
Once I got comfortable with that over the course of like 4 or 5 months, then I was like, wait a second, if I'm never going to visit the property that's 20 minutes away, what prevents me from buying one out of state where I could get better financials?
Yeah.
And use property management.
That's such a huge unlock. That's it. It really is. A lot of people have that. I know people that have a multiple $100 million portfolio, and they only just recently started buying stuff out of the state.
Yeah, and that's one of the keys to scale. Yes, you can. When you buy a property, I always encourage all my investors that I work with, if you're going to actively buy a property, always built in property management. We're going to underwrite it because we don't know when life is going to change for you. You might be happy managing this yourself, but I had 3 or 4 of my investors that I personally coached this fall. Spouse got into a motorcycle accident, another one their dad died, another one their father-in-law died, and so but they were all able to shift very quickly their portfolio to property management. Or they already had it there and they were able to lean on it, and they were able to focus on themselves and then get back to acquisition. But so that's one of the kind of the first keys to scaling. I mean, I love the book, by Dan Sullivan, Who Not How. So
great book.
Yeah, right. That is, a great first step. But those first properties, I was kind of biting off incrementally, small pieces. So the first property, can I run a rental? Yes. Am I going to go there? No. Now I can buy out of state. Now I'm buying a turnkey property with a property manager. Does that all work? Yeah. Okay. What can I tweak here in the model that just pushes my boundaries a little bit? Then I started to get buying something that just needed a $10K worth of rehab. Great. Property manager handled that. That worked fine. Then I had $20K, $30K, $50K, $60K rehab. Can we do a flip through property management? I'm just quickly inching up the notch there. And then I started using hard money in there. So I could then refinance out my own capital. So when people say, how did you scale to 40 properties? I had a finite bucket of cash. I had to get very savvy with learning how to recycle that cash over and over and over again in order to scale.
That's fascinating. That's got me thinking, because we just did a hard money as well. So we borrowed hard money to do the down payment. We had it's such a good deal with seller financing. We were able to acquire the property, did some more, got a new lease signed on our commercial property. And then the bank wrote us a note for both loans in total, paid off both investors with interest as agreed, and we bought essentially the property with no money out of pocket. Now we have an infinite return on it and paying us at X amount of cash flow a month, right? For me and Graham. And what you're saying is the same thing. You're just probably, if I had to guess, you're probably doing, what is it called? It's like purchase price plus cost, hard money notes. Is that basically what you're saying?
Yeah. So I would buy I'd find a property where between the purchase price and the rehab, I was probably in that market was in probably somewhere between 65 to 80% loan to cost on the property, which was gave me a hefty cushion to pull out majority, if not all, and sometimes a couple times more than what I actually had in the property. How cool is that?
That's amazing.
You actually get paid in order to rehab the property, but this is a very different market than then. I mean, it's not to say that those deals don't exist, especially on a larger scale, larger multifamily deals. It is still possible to do that. Sometimes you have to it's called a BRRRR, you buy, rehab, rent, refinance, repeat. You might have to, instead of getting all that done in say 60 days or 90 days, you might need to, wait a year or two to pull out your capital. It's still possible to do those deals. And if you get half your capital back as opposed to all your capital back, that's still a win as well. Now what I always like pointing out, to any investor is, even though that might be your intent, you have to pay attention to market shifts. Debt is an amazing tool to build wealth. It is also a horrible tool sometimes and can destroy wealth. So you have to use it wisely.
Yeah, there's a lot there, and you got me thinking about multiple different things, but I do want to go back because you mentioned you started because you wanted to have more income coming in with, started raising a family and stuff like that. I feel like that's a lot of people's motivation. And then they wind up creating themselves a second job without doing property managers. So Graham and I are building a portfolio. We've got 3 buildings to ourselves, and we own some buildings with our firm. And we don't have any property managers on our current ones because there's only 3, and there's really not that much when it comes to commercial that we have to do day in and day out. But there are things that do come up, and we'd like to do that. At what point did you hire the property manager?
So I quickly learned in all my deals to put in that property management calculation.
Okay.
That way, I still have 2 deals that I manage on my own. They're pretty low key. I handle the tenant turn and maybe 1 or 2 other things like throughout the year. Super not, non-issue there. But if you want to scale, it's all about as a CEO of your own business, you have to maintain your time and attention. So are you doing a task that you could outsource to somebody, say for like $25-$50 an hour, while you can go do a task that will generate you $2,000, $10,000, $20,000, right?
Yeah.
So you have to think in terms of like what your time and attention is worth. Can you do property management? Absolutely. Anybody can. Should you be doing it? Absolutely not, right? And so when the question that you asked is, when do I get a property manager? I would say yesterday. Make sure that's built into your model. When do you have to have a property manager? It's whenever you're butting up against that ceiling achievement, where your time and attention is being diverted, taking care of low dollar tasks where you're not unable to scale. Now, this is where especially the first private equity firm that I was a partner at, very West Coast driven people, what is the lifestyle called? 996, 9 a.m. to 9 p.m., 6 days a week. Like they never take a minute off, like super hard workers. And they, burnout was not uncommon. Yeah. And so just because you can be doing something, we always need to be thinking about what is that life that we want to design.
Yeah.
Now, so somebody might go, Whitney, you said, yes, get a property manager here. Now not, and now get it, and now not. I'll leave you with one other framework. Doing hard things now so you can have an easy life later could be, a framework to also work with. Like if you need to manage your properties right now, even though you could get a manager, if you're young, you have the energy, your time and attention is not diverted, very much by doing your own property management, and you can save, say $15, $20, $50, $70,000 a year so you can scale faster, consider that. But don't be so heads down don't forget to pivot.
Yeah. Another framework to kind of think about. Benjamin Graham wrote Who Not How with Dan Sullivan. He recently did his own book. I'm not familiar with it or not yet, but it's Silence of Scaling. And it talks about what is your goal? It's like basically your impossible goal. What's impossible for you to achieve in an X amount of time? Probably like a year, maybe 3-year goal. Whatever isn't that is pulling you down from getting there. So if you wanted to achieve, we'll say like 50K cash flow in 3 years, is buying single family homes a distraction? Or is that what's going to help me? Is buying, 10 units and smaller, is that distracting me? Should I go buy 40 units? You have to change and rethink everything. So like property management isn't even a question anymore. You're 100% getting to put property management on all your properties so you can focus on finding the right deals, taking them down, talking to investors, doing what you need to do to take down those deals. I want to talk about your first multifamily deal, but I also want to ask this question in a preference of it a little bit. Was there a big cash flow difference in your residentials versus when you started syndicating these bigger multifamily deals?
Hey, it's Jesse.
I'm here to share an uncomfortable truth. Most investors never make the jump into commercial real estate because they don't understand how it really works. They see big numbers, assume bigger risk. They see these loans and they get scared. They think you need millions and it's only for like Wall Street guys. But commercial real estate has clear systematic advantages. Residential just doesn't. And it's for everybody. Better cash flow, more creative financing, and properties that can replace your income from just a single deal. Scott Shield breaks it all down in his free guide, 7 reasons you can make huge profits in commercial real estate. It's not theory, it's the exact system he's used for 30 years and taught to thousands of investors who've built real wealth. Grab the free guide, it might be what you need to finally make that leap. Text GUIDE to 888-653-1199. Remember, it only takes one deal, one time to change your life forever.
Well, I would love to stack onto what you just said really quick.
Okay,
you have to be able to kill the cows in a way. I maybe that's not the right way to put it, but I hit this impasse, during COVID. All of a sudden my daughter was in school full time, and now that she's schooling from home, I wasn't homeschooling her. She was in an online program, but I still had to take care of her. And all of a sudden, half my intention's gone and diverted. And we were running a camper van rental business at the time that was mad cash flow, not so great on the equity build or anything like that. We also had short-term rentals, and we had to really streamline our thought. And we looked across all of our different business lines, majority of them in real estate or some sort of real estate adjacent business, and figure out what was going to be able to give us the best capital preservation, cash flow growth, tax benefits, diversification in our portfolio. And then even if it's not, all of our businesses were performing or at least breaking even in a COVID market, right? Hospitality struggled there for a little bit.
For sure.
And we killed 3 business lines overnight, exited them. And so you have to be able to do that. And that allowed me to really focus on, one, things that changed in my life that I had to do. And then, also to scale the other parts of our portfolio. Now, you asked what was my cash flow differential between owning the single families and then getting into multifamily real estate. Remember, I did multifamily passive and then multifamily active. Okay. So if we compare the cash flow between single family rentals and multifamily passive, it was pretty seamless, right? I was earning about the same cash on cash return, getting similar equity bumps, similar tax benefits without any of the headaches, right? Now, my portfolio is with the property manager. So, a lot of people are like, why would it, it's all passive now. I'm with a property manager. No, you still have to manage the manager. So, I was trying to find the property, acquire the property, get the lending on the property, handle insurance claims, managing the property manager. I was still very active in the business. When I pivoted into passive multifamily real estate, there's a whole framework that you need to follow in order to get into with the right operator into the right deals. So it's not just go find a deal tomorrow and invest. You could do that. You might lose a lot of money, right? And that's what I educate people on in my YouTube channel, Passive Investing Made Simple. Compared to active multifamily investing, now I'm scaling. So I can't just take one single family rental and compare it to the cash flow I was making on my active multifamily deals. I have to compare it, the whole 40 unit portfolio, to say a 52 unit building. Now, in theory, on paper, I should have done much better in that first 52 unit building than I was a partner on. That was my first deal. It was a lot of lessons and learning there. That didn't happen, but on subsequent deals, kind of got my education and made a little bit better cash flow for sure on that.
Okay. And I was just curious because my next question is, do you recommend people, so you're kind of doing a little bit of each side, you've got the live and flips going, and then you've got
we killed that part of the business.
You did,
right?
Okay.
As soon as I transitioned into larger scale real estate, we pretty much got rid of the whole 40 unit out of state single family rental portfolio over the course of about a year. So I'm all about hyper focus, on a strategy, not necessarily an asset class, but on a strategy for sure.
Okay, gotcha. So if I'm new in real estate, let's say I have a little bit of money, nothing crazy, and I want to get started, would you suggest me go try to find some single family homes, or would you say let's go straight for a quad? Why not? What do you think?
So it depends on where your risk capacity and your risk tolerance level is. If you have purchased a single family rental before, say like the roof over your head, you have a lot of translatable skills. So to go get a single family rental, one unit, probably not a big deal. Two unit, still probably not a big deal, but now we're throwing in a couple additional, criteria that you need to look at. Even a quadplex, not a huge transition there. Why? Because my lending terms don't necessarily change. I can still get residential lending on a 1 to 4 unit property. Now, again, it's usually easier, from a mindset standpoint, if we just change one small variable at a time. So get into especially if we're trying to build momentum and speed, get into the single family property. And then the next one is a duplex. Then the next one is a quad. Then the next one maybe is like an 8-plex or a 10-plex, right? If we're just changing the variable, right? That is a great way to kind of scale the property, because, by the time you have a single family, a duplex, and a quad, you already have 7 units. You're already kind of envisioning how to manage a multifamily property, right? You have multiple tenants, multiple roofs, multiple systems to take care of. So at that point in time, I'm just switching the lending to get you into multifamily.
Okay.
But up until that time, I'm changing the unit count and the type, how many people are sharing walls together, which can be a really interesting transition for a lot of people. What I see a lot of investors do, especially ones that I coach, one-on-one, is they get really attached to the returns on a property, and they're hearing information from all over, Bigger Pockets, all the TikTok videos, you name it.
Yeah.
And they come in single focus, like, I'm going to buy a single family property. And then after about a month, they're like, well, what if I got a duplex? And then they start underwriting. Well, what if I got a quadplex? And now they're 6 months in and they're confused on what to do. Whereas if they just focused on getting that first property, they're going to learn. They've entered the game. They're going to learn so much there. And then we can go after the deal that you really wanted to try to focus on next.
Okay. You had me thinking about diversification, but focus. What does that look like for you when you're trying to be hyper-focused, but you also kind of want to be a little bit diversified in your portfolio?
So to get diversification right off the bat in active real estate is hard. It's kind of like, it was Carnegie, I believe, said, like, put all your eggs in one basket and watch it like a hawk.
Yeah.
And so what I, encourage investors to do is, let's have the lens of achieving diversification, say within the first year, 2 years, 3 years. Okay. But we've got to start somewhere first. Otherwise, you're not going to build momentum, right? And you'll never get started, which is not what we want. Now, that's if you're getting into active real estate. You have to think about, you have to have the plan, you have to execute over time. It's easier as a passive investor to achieve diversification quickly because you're using somebody else's systems. Okay. If you're actively investing, you have to be the expert.
Yeah.
Okay. Or you have to partner with somebody that if you are bringing a skill, say, such as underwriting, and you need somebody to be an operator, you have to partner with your opposite skill set. Whereas if you are a passive investor, now you are bringing the capital and you have to find the operating team. And it's going to be quicker and simpler for you to diversify. Now, again, you have to build skills in either active or passive real estate. I know plenty of people that have active portfolios and all they do is multifamily.
Yeah.
So they just double down in their particular area, and they put all their eggs in one basket and they watch it like a hawk.
Yeah.
So they do achieve diversification outside of their active portfolio with other passive investments, maybe other debt investments, investing in other passive businesses like express car washes. But when it comes to their active portfolio, they do one thing and they do it incredibly well.
That's something that Mikey Taylor, I don't know if you know Mikey Taylor, he said he's like a pro skateboarder, but he does a lot of like multifamily development stuff now. But he's like, if I do one thing and I do it super well, and that's the one thing that I'm focused on at all times, and the other person's got 50% focus, I'm going to beat them every time. So as an active investor, I 100% agree. Our 7 buildings are all within like literally 2 miles of each other. So we're very focused on eggs in one basket in that situation, but we've got our hawk eye on it. Talk to us about about the car washes and stuff and what you see there. And I feel like it's definitely in the last couple of years just blown up and people are doing it left and right. So talk to us more about that. I'm curious what your thoughts are and what that looks like for you too.
Yeah, when COVID hit in 2020, our managing partners at passiveinvesting.com, even before then in 2019, they could see cap rates compressing on multifamily assets. They're like, cash flow is hard to get. Our investors are hungry for cash flow. They were like, and we wanted to be able to provide diversification for our limited partner investors, right? So our limited partner investors typically are, high income earning professionals, doctors, lawyers, tech workers, that sort of thing. So they don't need to be going and buying their own single family rental properties. Their best use of their time and attention is scaling their job or scaling their business and then taking that active income and turning it into passive income and long-term wealth. So, but we know the importance of diversification. They do too. And so we were kind of sitting here going, well, let's look at laundromats, parking lots. We did self-storage facilities for a while.
There's tons of ways to get distracted.
Yeah, we were looking at other ways to help diversify the portfolio, but our investors were like, we want cash flow. And so express car washes were a unique opportunity. It's still early in its concentration phase. So, there was an opportunity to buy these mom and pop express car wash tunnels, so think of it. Yeah. Like you don't go, we're not talking about like the 5 to 10 unit bay where you pull your car in and then you scrub it down with a brush and you pray your kid doesn't spray you with a hose. We're not talking about the car wash that's attached to a gas station. We're talking about the one where you can get like 30 to 40 cars through a tunnel at the same time. And, you don't have an army of people there to dry your car either, right? Like everything's automated. That's the type of car wash. You can wash 400 to 500 cars a day with like 3 full-time employees. And so there's an immense operational scale there. But the hard part is that, mom and pop, owners, they needed to get to 5 to 10 properties in order to hire a regional manager. So we saw the opportunity to aggregate investor capital, build our own property management company, and consolidate that scale rather quickly. Now, at the same time, you see a lot of developers going into primary markets and building like what it seems like an express car wash on every single corner.
Yep.
When that started happening, we pushed pause and moved more towards the secondary and tertiary markets. 72% of people in the United States, the households own at least 2 cars. Okay. So this is a high density type of business. It's almost like everybody needs a roof over their head, right? That's why multifamily does so well. Almost 72, households have 2 cars. And I think like 69% have 3 or more cars. So there's a lot of opportunity here. And, most people can't wash their car due to laws and covenants in their driveway anymore, or they don't want to. It's so why spend half an hour washing your own car when you can like just pull through and get it done, in 5 minutes?
Right.
Probably for much cheaper, I'm beginning to realize. Long story short, we started consolidating. We built out the property management company. We exit out of, we're primarily in the secondary markets. We go from secondary to tertiary. And then, with the rise of interest rates, we saw a little bit of cash flow compression and the glut of delivery of the development in the primary market. So we've been paused on acquisition in the past year and a half, and really just focusing on stabilization of the current portfolio, but also allowing that kind of like absorption to burn off a little bit. That way we can get back into either acquisition phase or ground up development, because we do both.
Okay. So who is operating? I know you said you built a property management company, but who is operating the business of the car wash itself?
We are.
Okay.
Yep.
Okay.
Yeah, we're 100% vertically integrated. So our property management company hires and trains the teams and puts the local manager in place on every single property. Our property management company is negotiating all the chemical purchases. They're purchasing and maintaining all the equipment, even down to the landscaping. Like everything is like vertically brought in-house under the property management company. As such, most of our car washes, our Hurricane brand of car wash, is on the Eastern coast. So think like Virginia down to Florida, as
Yeah.
far in as Alabama in some cases.
Okay. You guys said you do ground up as well?
Yep, we've done ground up is actually we've done ground up in a couple of tertiary markets, and the basis on that property and the income that we can generate is almost equal, if not sometimes a couple cases exceeds what we've purchased, turnkey. And so that is a unique opportunity for us. I mean, if you think about it, I mean, majority of that build for express car washes occurred in the primary market. So I live in Boulder, Colorado.
Mm-hmm.
We're talking about it would have been right on the outskirts of Denver proper. Whereas you could go, if you're familiar with Colorado, I could go to Berthoud, Colorado, and which is, outside of Denver, smaller market. I don't know if it's quite tertiary anymore, but I could build a facility there, and there's enough people there. They all have cars.
Yeah, everybody's got cars.
Yeah, I don't have to justify income, right?
Yeah.
They have a car.
Yeah.
And the car needs to be maintained. And when we have a down market, a recessive market, I mean, call it a recession, not a recession, whatever, a challenged market, people can't go out and buy more cars. They have to keep the car that they have and keep it maintained.
Yeah.
And one of the ways to do that is to keep it washed. I mean, more people spend time in their cars sometimes than they do in their house. I mean, we haul our kids to and from school and all their practices in a car. People do business out of their cars. They take their coworkers to lunch in their cars. I mean, sometimes people take better care of their cars than they do their property.
Yeah. And if I can, in tertiary markets, you see more of that as well. Yeah. And they probably have more, some of them have more cars. They may not be expensive, but they'll have more of their cars. But I know we only have a few more minutes left, so I want to hit a couple more things. You talk a lot about like generational wealth, and you've mentioned it a couple of times. I want you to talk about that and how you kind of advise people. How do you set up investments? Like, what are you doing? Like, just kind of curious to hear you talk about setting up generational wealth through real estate.
Yeah. So, as I was, scaling my portfolio again, remember I started in 2002. I didn't do it right then, but eventually a few years later, I started writing down all my lessons and learning. How does money work? How do people create money? What are the rules? What are the order of investments that you should make? Do you contribute to your IRA first? Do you do your HSA? Do you do your Roth? Do you save cash for an investment? So I'm testing and tweaking frameworks left and right. And I'm finding that even though I'm stumbling across things for myself, I really wish there was like a framework that I could just snag from somebody else and run with. And then I realized over time that there are some universal truths when it comes to how money works for a lot of people and how a lot of people should deploy cash. But the big thing is when people start deploying cash into investments, often they're not deploying capital from a position of strength. And that was huge. And so I'm writing all these lessons and learnings down. I'm tracking everything for my daughter. Like if she needs to scale her own portfolio, what's the most important thing that I can give to her? Yes, I can give her money, but if I gave her the knowledge, if something happened to me, if I gave her the knowledge. So I have everything written down. And then I partnered with Bigger Pockets to turn that into a book called Money for Tomorrow, How to Build and Protect Generational Wealth. And really the book is for anyone, whether you're a new investor who's trying to figure out how to get into your first investment or stabilize your first investment, or you're a seasoned investor that's kind of trying to figure out, why do I feel really off-put by today's market? Why is it so risky for me? So this goes through the objective of building wealth. It goes to the 4 core rules that every investor has to abide by in order to build and scale wealth. How do you create it? How do you keep it? How do you grow it? And how do you pass it on? Those are 4 key functions. Most people only master 2 of those functions. They don't master all 4. So in order to be successful, you have to master all 4. And, then we get into the strategies, not the tactics, but the strategies of, that have held true on investing across millennia. And really what I wanted to do is provide somebody a framework to either, if they're starting off, they can read that book and implement everything and, be like 85-90% of the way there on scaling their portfolio. Now they're just filling in with the tactics that they love best. Is it industrial real estate? Is it self-storage, right? Or if it's somebody that's seasoned investor and they're just kind of going like, sometimes it's what you don't know that gets you in trouble, or what you do know that you think is true that gets you in trouble, right? And so that can also help somebody sort out, what's not off in their portfolio.
That's interesting. I'm definitely gonna have to pick up that book and dive through it myself. I'm fascinated about money and financing and making sure I'm set up. I'm interested in stocks as well. I know a lot of real estate guys are like anti-stock. I'm not necessarily one of those guys. I do like stocks. I just bought Lululemon stock. I don't know if it's a bad move or not. We'll see. I'm not telling you to go buy Lululemon stock. That's just what I did. So
I think it's more over understanding the strategy that you need to have in order to build the wealth, because we don't get into what stocks to buy. I don't get into opportunity zones. We'll break apart real estate at extremely high level, because that's kind of what I love and what I'm partial to. But we get into the 7 pillars of wealth. Like when you go into an investment, how does it preserve capital for you? Create cash flow, create equity, create diversification, create tax benefits. And then there's some other pillars in there that you need to take advantage of as well if you want to accelerate the wealth build. So that framework can apply to stocks, bonds, and mutual funds.
Okay.
Real estate, opportunity zones, hedge funds for, all intents and purposes. But it's what are the fundamentals that you have to master to fully understand if that works for you?
Okay. My last question, I know you got to go, is what is one actionable piece of advice you would give 25-year-old Whitney that you think would have really changed the way that you build your portfolio, or just maybe, I don't know, personally or financially helped you a ton?
I'll give 2 quick ones.
Okay.
One, go back and pick up the book Money for Tomorrow. That's the framework, right? Like I would be like Back to the Future, right? I'd go back and hand the book, right? Like not the newspaper article, right? But the book. If you guys don't know what I'm talking about, go watch the movie Back to the Future. It's amazing. The other thing is real estate is a partnership game. I would tell myself, don't do it all yourself. Get in partnership, whether that is if you're actively investing, who's your who that you need in order to achieve the how. If you're passively investing, who are those operators that are you can know, love, and trust to help you build and scale your wealth?
No, I think that's amazing. We talk about who, not how all the time on here. So if you, for some reason you haven't, this is your time to listen to it. Go read that book and go read Science of Scaling by Benjamin Hardy. If you haven't read that either, that definitely changed us a lot. Whitney, I truly appreciate your time today. I think you've given a lot of amazing advice. Where can people find out more about you and connect with you?
Yes. You can find me, just look up the website, passiveinvestingwithwhitney.com. There, you can schedule time with me and we can talk about your investing goals and how we can turn your active income into long-term passive income and long-term passive wealth.
Awesome. Thank you so much. We'll catch you guys in the next episode.